The following informative video is about futures trading, a highly risky endeavor, with the potential for both great profits and significant losses. Please be aware that in the event of extreme price movement, there is a chance that all margin balance in your futures wallet may be liquidated. So, don't risk money you can't afford to lose. With love, from Hegion. Binance is a global cryptocurrency exchange that provides a platform for trading more than 100 cryptos. Founded in 2017, Binance has propelled itself within 12 months to become the biggest crypto exchange in the world, in terms of trading volume and reliability. Today, most crypto investors would have an account at Binance. However, that didn't stop them from innovating and offer better and relevant solutions to its users. In September 2019, Binance Futures Bitcoin derivatives market is launched, and is now made available to users on the platform. This new feature allows traders to use leverage and to open both short and long positions. The user interface at the futures platform is very similar to that of Binance's spot exchange, which makes the transition very easy, even for my grandfather. The user experience is just as smooth, and trading is pretty simple. In this video, we will be giving you a quick walkthrough on the basics on futures, and how everyone could eventually try out using the futures platform. If you are currently an existing user on Binance, you should be able to create a futures account in just over 2 clicks. After you have logged into your account, click on Futures, located at the top of the navigation menu. Next you will see Open Futures Account, and click Open Now. And that's it. You've now successfully bounded your Binance account with ability to perform futures trading. If you're watching this video, I'll assume that you may be new to futures trading. In order to explain how futures work, let's take the gold commodity as an example. Futures contracts allow players to secure a specific price of gold and protect against the possibility of wild price swings, up or down, in the future, thus it is aptly named futures. In some traditional futures markets, these contracts are marked for delivery, meaning that there is a physical delivery of the commodity. As a result, gold has to be stored and transported, which creates additional costs. With futures contract, you don't have to physically hold or exchange gold. This can be done through a cash settlement of equivalent cash value of gold. However, the price for gold in a futures market may be different depending on how far is the contract settlement date. The longer the time gap, the higher the carrying costs, the larger the potential future price uncertainty, and the larger the potential price gap between the spot and futures market. Sounds scary, isn't it? Fortunately, there is a more interesting way in dealing with futures contract. Binance's derivative futures consist of perpetual futures contract. The word contract means that you do not need to buy, or hold, an asset physically. While perpetual means that the agreement never expires. The perpetual contract is an attempt to take advantage of a futures contract, specifically, the non-delivery of the actual commodity, while mimicking the behavior of the spot market in order to reduce the price gap between the futures price and the mark price. This is a marked improvement compared to the traditional futures contract, which can have prolonged or even permanent differences versus the spot price. So what makes futures trading preferable over spot trading? The easiest way to think of this is that a spot price is the price to settle a commodity contract immediately, both the price and delivery terms. You are settling on the spot, hence spot contract. A futures contract will occur in the future, not immediately, hence futures contract. With a futures contract, you are locking in a price for a contract on a commodity, size, quantity, and quality, at a specified date in the future. You would think that futures prices will always be more than spot prices. But expectations of the commodity itself will affect the price as well. This includes whether it will go up or down in price, which is usually determined by supply and demand due to seasonality, weather expectations. In this scenario, futures prices can actually be lower than spot prices. To sum it up, trading futures can benefit traders over spot due to the following. Full transparency in pricing, order flow and execution reduces chance of fraud. Futures exchanges create a centralized marketplace and therefore a more level playing field. Near elimination of counterparty risk. Avoid hidden fees in spreads and interest rates. Known trading costs versus variable spreads. Benefit from span margin rules. And stronger regulatory oversight. If futures trading interests you, But you are afraid of risking it all at your first trading of futures? Don't worry. Our friends over at Binance have created a testnet which you may practice safely using the testnet tokens, without risking your funds. Therefore, your funds are safely. So, head over to testnet.binancefuture.com if you need some practices before you proceed with live futures trading. For those of you who are ready, let's get started to the real thing. First, you have to make sure that there is USDT in your wallet at Binance. Once you are sure of it, click on Transfer, which is located at the bottom right of the page. Next, enter the amount of USDT that you will like to deposit into your futures wallet. Click Confirm to proceed. The transfer should occur immediately, and you will be able to see your available balance in your newly loaded futures wallet. In order to better familiarize with the platform, let us look at the available order types that Binance have for you in the futures platform. There are 3 types of order available on Binance Futures: limit order, market order, and stop limit order. The first type is limit order. With limit orders, you can place an order at a specific price. The order will be filled if the price matches your limit price. Then, there is the market order. With market orders, the order will be matched immediately at the best available price. Finally, we have the stop limit order. A stop limit order is a conditional trade over a set time frame with stop price and limit price features. A stop limit order will be executed at a specified price after a given stop price has been reached. Once the stop price is reached, the stop limit order becomes a limit order to buy or sell at the limit price or better. During your trade, you will have come across profit and loss, or P&L. P&L can be either realized or unrealized. When you have open positions on a perpetual futures market, your P&L is unrealized, meaning it's still changing in response to market moves. When you close your positions, the unrealized P&L becomes realized P&L, either partially or entirely. Because the realized P&L refers to the profit or loss that originate from closed positions, it has no direct relation to the mark price, but only to the executed price of the orders. The unrealized P&L, on the other hand, is constantly changing and is the primary driver for liquidations. Thus, the mark price is used to ensure that the unrealized P&L calculation is accurate and just. That's it. I hope that this video has served you well in your journey as a futures trader. If you have more questions, feel free to take a look at Binance Academy, where they have tons of resources for all you need for cryptocurrency trading and more.